sort of the impossible thing to do in 5 minutes, but I'll try to do my best. And I think I'll talk about the uncertainties in the near term first. I think those uncertainties are huge. I think those uncertainties are part of the reasons that Saudi Arabia was so hesitant to add more oil in a very vocal and visible way in the Algiers meeting last weekend. So let me rattle off some of these uncertainties in the short run. First of all, we have an end of synchronous growth. We had last year, at this time, extraordinarily strong global growth, both in emerging markets and in advanced economies. And that gave rise at times, if we look at global demand growth, to a 6-month moving average of demand at around 2 million barrels a day at the peak. And now we're seeing a slowdown, a desynchronization of growth. And I think while we don't know the degree to which this may peel off, it looks to me that this is pointing to a lower GDP growth for the world as a whole. All other things being equal, that shaves about 100,000 barrels a day off of next year's demand theory. Secondly, we're in the middle of a trade war between the United States and China. There is a possibility that the current 10% tariffs on $200 billion worth of goods moves to 25% tariffs on January 1. We estimate that that shaves 1% off of China's GDP growth. That's above the number shaved off by the 10% tariff. And our expectations are that that would drive global oil GDP, global GDP down by 0.4%, shaving another 200,000 barrels a day off of product demand growth next year. So we're now at 300,000 barrels a day of uncertainty. We have, in addition to that, EM, emerging market currencies, that are weakening against the US dollar, increasing the price of oil in those emerging markets in local currency terms, and that could shave off yet another 100,000 barrels a day of growth. So we have uncertainties that I think can be rounded at the 400,000 barrel a day level for 2019 versus 2018, and that's a pretty large, broad amount of uncertainty for just the year ahead. Let me turn as briefly as I can to the medium term, and you yourself talked about the S&P expectations of a slowdown in a deceleration of the growth of oil as a transportation fuel. Let me just put a caveat on that for what is the medium term. So the medium term, it really is IMO 2020, which has significant impacts on a whole bunch of things. I want to put it in the context of a surprising change in the structure of oil demand growth last year. So if we look at the world from 2010 through 2016, the most remarkable feature is that diesel demand did not grow by 55% per annum. It didn't grow, it wasn't 55% of the incremental demand barrel. It was a lot lower than that, and in some years it was zero, in some years it was negative. And if we look at some of the causality of it, Chinese diesel demand, which had been growing for 20 years at 1.1 or 1.2 to 1 against GDP, went down to 0.5 to 1 in 2011 and zero in 2012, 2013, negative 2014, negative 2015 and 16, and all of a sudden 2017 saw roughly 150,000 barrels a day, fourth quarter diesel demand growth, and first quarter this year diesel demand growth. And the US saw the same amount, maybe a little bit more, 160,000 barrels a day of diesel demand growth in Q4 and Q1 of the last year. And India saw even more, equal to the combination of the US and China. So we had no diesel demand growth, and all of a sudden we had dramatic 500,000 barrel a day diesel demand growth annualized. It's slowing down a bit. But let's say we don't have the slowdown. Let's say we have a turn better for growth, and we keep adding 500,000 barrels a day of diesel demand. And that we get to 2020, when our expectation is that ultra-low sulfur marine gas oil will see about a 1.3 million barrel a day increase in demand against all other things being equal, 1.3 to 1.4 million barrels a day already in the market. So we could see the transportation fuel market actually tightening up before all those other things happen in your longer term horizon. So